Hello there, Prof. Aram here, and in this video we're going to look at the assumptions that Modigliani-Miller made in their first paper in 1958. In this chapter we're going to look at a lot of different theories regarding the capital structure of a corporation, but in order to understand those theories we need to understand the first paper very well. And to understand the first paper very well, we need to understand the assumptions that Modigliani-Miller made in developing that theory. So let's get to this. So Modigliani-Miller's study was based on some strong/unrealistic assumptions, which included, for example, investors agree on the expected cash flows from a given investment. This means that the investors have the same expectation with respect to cash flows from an investment in bonds or stocks. We call this homogeneous expectations. In other words, all financial market participants have the same expectations concerning different financial variables. For example, they estimate income or cash flows from an investment in the same way. The second assumption was that the bond and the stocks are traded in a perfect capital market, which means that there are no brokerage costs, no taxes, and no bankruptcy costs. Another assumption is that investors can borrow and lend at the same rate as corporations, which is usually not true. Usually, smaller investors have higher costs of borrowing. They cannot really get the same rate when they lend their money. But here the assumption is that if a corporation can borrow money at 5%, the investor can do the same thing. Or if the corporation lends money and earns 4%, then the investor can also do the same thing. Next, there are no agency costs. This means that managers always act to maximize shareholder wealth. So as an investor, I don't have to worry about managers misbehaving or misusing the cash in the firm. And then all investors have the same information as management about firms' future investment opportunities. We call this symmetric information assumption. Usually that's not the case. Usually the insiders of the company have significantly more information than the outsiders, but the assumption here is that both parties, the insiders and outsiders, have access to the same set of information. Then the next assumption is that EBIT do not grow. In other words, the earnings of the company are constant and they're not changing. And they cannot be affected by the use of debt because the EBIT or earnings are determined by the assets of the company, not how the company is financed. The other one is financing decisions and investment decisions are independent of each other. This means that the operating income is unaffected by the change in the capital structure. So you have these fixed assets, and then you have debt and equity here. What they're saying is that this is what matters. Fixed assets of the company determine the earnings of the company and the cash flows that the company generate. How you pay for them is not really relevant. In other words, when you're making a decision about a project, if the project is a positive NPV project, we're going to accept it. We don't worry about how we pay for that project. We'll do that later. But this project, if it's positive NPV, it's going to create value, it's going to create cash flows, it's going to create earnings for the shareholders, regardless of how we finance that project. Keep in mind that many of these assumptions are unrealistic, and when we will examine their consequence of relaxing them on later videos, but the importance of this first paper, the first Modigliani-Miller theorem, is that it provides a framework of thinking about the capital structure. It's just a starting point for the analysis. Later on, we're going to relax all these assumptions one by one and see what's the effect of that in our decision making regarding the capital structure of the firm. I hope you find this video useful, and thanks for watching.